Module 3: Risks and Challenges. In this session, we will cover the different types of risks that structured finance attracts. But first, let us discuss some of the challenges that different market players face while dealing with structured finance instruments. The first problem comes from the rating-based constraints being more present with a higher degree in tail events. The rating ranking of the expected loss or default probability does not capture this. The transaction documents are more likely to make it difficult for investors to gauge the riskiness of tranches. Many times, the managers themselves do not understand the risk they are taking, but are blinded by the temptation of adding more and more structured securities, which leads to increasing the risk of their portfolio, and it becomes higher than what was designed in the investment mandates. A simple step would be that investors shall not completely rely on the rating when assessing the risk and setting credit limits on their portfolio. The second challenge comes in the form of model risk. It is the same feature with pricing models used by deal arrangers and other market players and participants. Any misspelled model inputs simply bring high default correlations. The model risk is present with bond ratings as well, and is more identifiable in structured finance ratings. The rapid growth of structured finance markets introduces new asset classes and structures, and thus they bring more opportunities for unanticipated behavior by note holders and other market participants. The structured finance market is highly untested, and the policymakers, along with other market-involved parties, pay close attention to newly faced challenges. All right then, let us jump into the different types of risks present in the structured finance markets. The first one is the credit risk. Credit risk is the probability of a borrower defaulting on debt obligations, including the lender's risk of not receiving the principal and interest component of the debt. Both of these result in causing interruption with cash flow, default, and increased cost of collection. Interestingly, there are many types of credit risks in the structured finance markets. The very first one is default risk. This we can very well understand resides with the borrowers of the different loans and their defaulting on repayment. This influences all transactions like loans, securities, bonds, and so on. The second one is the concentration risk. This risk is faced by many big banks and financial institutions when they rely heavily on the structured finance market. If the entire market struggles, so do these banks and financial institutions, technically incurring massive losses. The third is the country's risk. We should not forget that structured finance is a whole market, and when the probability of foreign governments defaulting on their financial instruments results in an economic slowdown, ultimately affecting the structured finance instruments. Okay, so we have default, concentration, and country risk. The fourth one is the downgrade risk. As we discussed in the many financing challenges, this is a risk caused by falling credit ratings. It is advised that investors should not completely rely on them. This brings us to the last type of credit risk, which is institutional risk. Borrowers sometimes fail to comply with regulations, and intermediaries between the lenders and borrowers do contractual negligence. Coming back to discuss the other types of risks in the structured finance market, we come across the market risk. Market risk, by definition, is the risk that an investor faces due to the decrease in the market value of a financial product arising out of the factors that affect the whole market and are not limited to a particular economic commodity. Often called systematic risk, market risk arises because of uncertainties in the economy, political environment, natural or human-made disasters, or recession. In a nutshell, this is the basic form of risk that any investor faces in the stock market from time to time as the market shifts due to uncalled, direct and indirect factors. Again, the market risk is further subdivided into 4 types of risks. The first one is the interest rate risk. This arises when any potential change in the interest rates affects the value of securities or financial instruments. The second one is the foreign exchange risk. Now, this arises because of the fluctuations in the currency market. As we said earlier, every factor matters to the structured finance instruments and its whole market. There can be investors dealing in different currencies and may have to withdraw from the market. Commodity price risk is the third one. Again, just like foreign exchange risk, this risk is associated with commodity prices and the markets. Not only farmers, but small businesses, exporters, traders, and governments face it. The last market risk component is the equity price risk, which refers to the potential change in the stock prices of financial products. As equity is most sensitive to any change in the economy, equity price risk is one of the most significant parts of market risk models. Okay, now that we have discussed the default and market risk, we have arrived at operational risk in the structured finance market. Operational risk includes risks that include errors because of the system, human intervention, incorrect data, or because of other technical problems. This is a form of human error in manual tasks and activities. Therefore, it is present in every aspect of the structured finance market. A simple example of this would be a rating agency making an honest mistake, and through human errors, the financial instruments get mismatched and wrongly rated. Now, yes, there should be accuracy, an eye for detail, proper assessment, and carefulness, but human error can never be fully justified through logic. Financial instruments are always prone to such technical errors, intentional frauds, uncontrollable events, and gaps in flow. This brings us to the last type of risk that is observed in the structured finance market, and they are legal and regulatory risks. Both of them have separate definitions, but are very much associated with each other. Regulatory risk is defined as the potential for changes in regulations, laws, or policies to impact a business, industry, or sector, which could lead to increased costs, decreased revenue, or other negative effects. Regulatory risk management aims to identify and evaluate these risks and implement measures to minimize their potential impact. On the other hand, the legal risk is when there is negligence or a deliberate failure to comply with client obligations. From an investor's perspective, potential risks are associated with tax law violations. In some cases, regulatory risk comes under legal risk, with constant changes in the market by policymakers and market participants. Any new regulation can have a negative impact on the structured finance market. And as an entity or an investor, you should keep your eyes open for it. Moving on, we shall look at some of the historical failures of structured finance to have a balanced outlook on the entire market. Whenever we speak of something like a historical failure in structured finance, there will always be a discussion on the financial crisis of 2008. The central rating failure cause was the incorrect rating models that the rating agencies employed. The most important rating system flaw was the correlation defining method. This model assumed the possibility and probability that even if one borrower defaults, it would mean that another borrower would default on the loan too. So, the main factor in failure was the concept of determining correlation. But that's not all. There are other causes as well. One of the prominent ones is the lack of knowledge and absence of sharing information in real estate-backed collateralized debt obligations, which also includes the decreased and mediocre quality of collateral at the housing boom's peak. The rating arbitrage by investment banks sponsoring the financial transactions of structured finance were also at fault, which led to the whole crash and crisis. The article and case study were written in the event of the huge failure in the ratings of structured financial securities that led to the 2008 credit crisis. The article was an attempt to analyze credit rating agency reform provisions of the Dodd-Frank Act's improvements to the regulation of credit rating agencies. The Dodd-Frank Act plays a critical role in minimizing the possibility of future ratings failure. The Act does not make endeavors and regulate the rating process itself. Rather, it depends on the old and conventional disclosure and liability law strategies to spur accurate ratings. The Dodd-Frank Act runs parallel to the current guidelines of the Securities and Exchange Commission, which state that the credit rating substance and the restrictions posed by the regulators and legislators in this extremely complicated area. Let us end this chapter with this thought. The next and last module is the benefits and criticisms of structured finance. Let us jump right into it.